Hello and welcome to Pro Trader Strategies Market Commentary for Wednesday, October the 12th. My name is Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal, where I've commented on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these daily market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies that you can implement into your own portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios, and therefore what I'm doing could be counterintuitive to what you are already doing. Having that out of the way, let's get this on. A little bit of economic data, mostly across the pond. We got French final CPI coming in at negative 0.2%, right in line with expectations of the negative 0.2%. Anyway, on to industrial production for Europe was actually a little bit better than expected. Came in at 1.6% for the expected 1.4%, so slightly higher than that. We also got here in the United States, JOLTS job openings, which came in at 5.44 million versus the expected 5.79 million. So that's lower than expected. If we start seeing job openings, that opens the doors for more hiring, which is what we'd like to see. If we get more hiring going on, we could see a lot of these discouraged workers come off of what is not really considered unemployment, but the non-working force that isn't captured in that indice, get some jobs, get back to work, and get our economy going. So that's why if that number is lower, it is not good, if you will. Then we got a bunch of Fed governors speaking. We've got Dudley speaking. We've got George. We also have the anticipated FOMC minutes at 2 o'clock Eastern, 1 o'clock Central. So keep your eyes out for that. People are going to be looking into that in detail and see what little lines are different from the previous FOMC minutes to see if they're more bearish or I should say more dovish or more hawkish. All right, so hawkish would be raising rates. So that's going to be the interesting thing to see how that all came about and who voted in which direction. Anyway, on to the overall markets. We got crude oil down just about 60 cents right now. I talked about this yesterday, looking for it to come back down and settle inside of the value area. So this is the value area high. It looks like we're going to do that. So I've decided to try and put on a couple of oil trades that I haven't actually gotten hit on, which is surprising. It seems like the indices are rallying as oil's coming off, which is a little bit bizarre. The indices, like the ETFs for oil. On to gold /GC, also down. You know, yesterday was a little bit bizarre. We had a big down move in the overall equities. We also saw gold continue to slide, and we saw bonds come off. So those two fear factors weren't getting any type of reaction to the sell-off. I talked about it. I believe it's because we're still stuck in a range right there. I mean, despite the fact that we did have a big pullback, we had some earnings come out that weren't really as well as expected. A lot of the biotech started coming off, and we also had Alcoa not come out with earnings that were better than expected anyway. They were actually worse than expected, so it had a slide. So that was a bit of the bearishness in the overall market yesterday, heading into this earnings season that we're just about ready to get into full swing with. Then on to the bonds. This is what I'm talking about. Bonds, you know, didn't react despite the fact that the overall equities were down quite a bit. We actually came and settled below this 50 Fibonacci and continuing down today. It's looking like the last couple of days lows is holding as support, but well, we're going to have to look and see what that is. I was expecting it to kind of bounce around here in between this 38.2 and the 50 fib level, just because this is where the point of control is. Not a whole lot of stuff coming out, and the FOMC, a lot of things there, to me, made it seem like it was going to be a pretty benign sideways move in the overall bonds. But we'll have to see how that works out. This is what I'm talking about right now. The Dow Jones, despite the fact that we had this major drop yesterday, the 9-day moving average is below the 50-day moving average, as it has been for several weeks now. But this big move down really has found support at this level here and been rejected. That's going to be the line in the sand. The further this goes on, this 200-day moving average is going to slightly move up there, and that will act as support. So basically, they're trying to repel this whole area right here for the bulls and try and keep it into that trend, if you will. Today we're pushing higher just by a little bit, taking back about 33 points that we lost yesterday. A little bit of mixed bag here. We got the Nasdaq down just slightly, but not really outside of this range necessarily. Yesterday we did kind of break it just a little bit, but I was talking about this being the low area and the high area that was going to be the trend sideways moving forward. We could easily start seeing this come down, maybe test this value area high, start filling in some volume here. Then on to the E-mini S&Ps. They are up on the day just by a point, but again, E-mini S&Ps did break down below this, but there wasn't really a whole lot of fear. This is a pretty tight range right there, but the real support resistance area is going to be right in here. This is going to act as a lot of support right here at about the 2114 area. So keep that line in the sand on your sticky notes. Here's the breakdown of the E-mini S&Ps. Really pretty quiet. Everybody kind of waiting for the FOMC minutes. I think it's going to be pretty quiet heading up until that time, which is usually what happens during the FOMC and the minutes releasing. People are just waiting for that. Don't want to really rock the boat and put on big positions ahead of those. On to XOP. XOP is a strategy I'm putting on, and basically I'm looking at it for the downside here, because we came off, this is what I was talking about with crude oil being down, getting back below the value area low. This tested the value area low several times and failed on it. So I'm looking for a little bit of a pullback here in crude oil. So I'm doing the November 36.38 put spread. So I'm buying that, paying 74 cents for that. So, paying 74 cents to make $1.26 on that strategy. If I can get a bit of a pullback, looking for it to really come back down here and at least test these moving averages. And if you watch any of my market commentaries, pretty bearish oil. I think there's a glut out there, but since we've had disruption in the Gulf due to the hurricanes and things of that nature, there's a lot of oil out there that isn't being counted as inventories. So as we get these DOE numbers, they're starting to look like they're coming off a little bit on the inventories. They're really just kind of going through the inventories they already have and producing gasoline and distillates, which are actually increasing in inventory. So we're just not moving the distillates, we're transferring it from one product to another by refining it. But the reason why we're seeing the drawdown in the DOE is because there's all this oil coming into the Gulf that hasn't been able to make it to port, if you will. All right, so that's about all I got for you guys today. Friday's webinar is going to be on the strangle, and I'm going to go through all my rules of that. I'm going to basically go through this step by step. We're going to do the short strangles, then we're going to do the long strangles. I'm going to talk about also in the short strangles how you can define that for an IRA, make it IRA appropriate. It'll still look like a strangle, it'll feel like a strangle, but it will be IRA appropriate for you guys. And that way you don't always have to do the iron condors according to my rules, which are a little bit tighter to the market. Strangles, I like to go a little bit further away, and I'll show you guys how you can do that in an IRA. So that's all I got for you guys today, other than if you can't take that, take it easy.